In today's episode, we're diving into the financial asset that's delivered the most explosive gains this year: gold. If you had the foresight to allocate to gold last year, your holdings are likely up more than 60% as we speak. That gives you a sense of just how intense this year's gold price surge has been. Yet what's truly alarming is that right now, I simply cannot identify a single compelling reason to bet against it. Gold could ultimately reach levels so extraordinary that they defy all our expectations. It almost feels like we've circled back to 1971, when the United States dismantled the Bretton Woods system and severed the dollar's tie to gold. In the brief years that followed, gold's value multiplied by more than 24 times. So what has ignited this renewed frenzy in gold today? And why does the momentum show no signs of slowing? In this episode, we'll unpack the fundamental drivers behind it all, step by step. To start, let's clarify a key dynamic: the true connection between gold and the dollar. Gold is inherently monetary, its value rooted not in decrees or legislation, but in the immutable laws of nature. It is scarce and laborious to extract, impossible to counterfeit, and impervious to corrosion, decay, or deterioration. Bury a dollar bill in the soil and within a year it becomes mere refuse. But enter a gold coin, unearth it after a millennium, and it retains its utility for exchange. This is money in its purest essence, enduring purchasing power. The dollar's power, by contrast, stems from collective faith in the backing of the world's preeminent superpower, the United States. America lends its national might as collateral, rendering the dollar the most triumphant fiat currency in history, yet at its core it remains an institutional construct sustained by human agreement on its reliability. Gold and the dollar operate like opposite ends of a seesaw. So long as confidence endures in America's fiscal stability, institutional integrity, and monetary restraint, the dollar's credibility stands unshaken. But when that faith falters, gold demands a reckoning in its valuation. That is precisely what unfolded in 1971, after the abandonment of Bretton Woods and the dollar's liberation from gold. Within a few short years, gold's price erupted 24-fold, as skepticism toward the dollar took hold. Freed from its golden restraint, the immediate concern became unchecked money creation and eroding purchasing power. The instinctive response? Abandon the dollar in favor of tangible assets like gold. In 1971, an ounce of gold fetched just $35. By 1980, it had climbed to $850, a staggering 24-fold leap over 9 years. The dollar, meanwhile, suffered from its fractured anchor, dragging the U.S. economy into devastating stagflation, stagnant growth on one front, rampant price increases on the other. Inflation peaked at 14%, oil prices soared, stocks plummeted, and household savings rates plunged to historic lows. Relief arrived only in 1980 with Paul Volcker's appointment as Federal Reserve Chair. He committed to reclaiming the dollar's trust at any cost, deploying the most aggressive measure available: aggressive rate hikes that propelled the federal funds rate to 20%. The toll was immense. Countless businesses collapsed, millions faced unemployment, mortgage defaults surged, and families tumbled into hardship overnight. America endured profound agony, yet the strategy succeeded. Inflation tumbled from 14% to 3%, the dollar regained its footing, and international capital returned in force. This chapter of history imparts a stark lesson to the world. While limitless money printing may yield momentary prosperity, the forfeiture of monetary trust exacts a ruinous toll for restoration. And today, we appear poised on the edge of a familiar precipice, with the dollar's credibility once more in question. At first glance, the United States remains the globe's dominant force: a thriving economy, robust consumer spending, ascending stock markets, and manageable unemployment. But beneath this polished facade lies a structure of credit that grows ever more precarious. Over the last half-century, America's approach has evolved from preserving dollar integrity to gradually eroding it. Governments have borrowed relentlessly, inflating the national debt like an unchecked balloon with no end in sight. Nor can we expect the Federal Reserve to summon another Volcker-like figure bold enough to rebuild that trust. No leader dares risk reigniting the bankruptcies of yesteryear. Even under this Republican administration led by President Trump, confronting a staggering $36 trillion debt, the focus isn't on austerity or repayment. Instead, they've opted for a more calculated strategy: expand the denominator. In essence, if the debt numerator proves immovable, inflate nominal GDP to enlarge the base. A sufficiently rapid denominator growth alleviates the burden. Put differently, devalue the dollar and allow inflation to gradually erode the obligations. a tactic reminiscent of China's former land finance model, albeit in a different arena. This explains why the Trump administration's arrival has not bolstered dollar confidence, but instead accelerated the rush to gold. Markets discern the core of Trump's economic vision: perpetuate the erosion of dollar credibility through controlled inflation, dissolving debt over time and trading endurance for immediate vitality. The nation projects an image of vigor, rising equities, vigorous consumption, solid employment, yet the dollar's real value diminishes in silence. This is the sobering truth confronting contemporary Americans. Irrespective of the president or party in power, genuine debt reduction remains off the table. Fiscal contraction invites recession, and recession forfeits electoral support. Nothing outweighs the imperative of votes. The Federal Reserve, too, has transformed far beyond Volcker's era. Decades of observation have mapped its thresholds. At the slightest disturbance, it resorts to monetary expansion as a safety net. Consider this: even if Paul Volcker were revived and reinstated at the Fed today, the institution's current landscape might deter him from another round of draconian hikes. In the 1980s, debt hovered at 30% of GDP, rendering the pain tolerable in Volcker's calculus. Today, it stands at 125% of GDP, where each 1% rate increase inflates interest costs by hundreds of billions. This is why President Trump persistently urges Chair Powell toward rate cuts. The fiscal apparatus is already gasping under debt servicing demands. Thus, the Fed's sole viable role now is economic stabilization, ensuring dollar credibility drifts downward inexorably rather than rebounding. This is the bedrock rationale for gold's ascent, and the source of my inability to envision its decline. Frankly, no viable path to dollar restoration presents itself. In recent years, central banks have emerged as gold's most voracious purchasers, shattering records annually. Remember, central banks do not trade like individual investors chasing short-term gains. Their acquisitions serve strategic reserve purposes, not profit motives. Their surge in gold buying is a direct counter to the dollar's waning trust. As this pattern persists, so will the purchases. Currently, global central bank gold holdings comprise about 30% of foreign exchange reserves. Should that proportion climb to 50%, gold prices would need to exceed $5,790 per ounce to equilibrate. You might wonder, with America's AI and technological renaissance underway, could such innovation mend the dollar's credibility? Regrettably, no. Technological advances undoubtedly enhance productivity and elevate GDP, but they fortify the productive capacity, not the faith in fiscal governance and institutional soundness. Imagine the U.S. government as an individual of exceptional intellect, generating substantial income year after year, yet unable to curb a compulsion for exhausting credit limits. As a credit evaluator, would you award a superior score? This year, he earns $1 million and squanders it entirely. Next year, a superior role yields $10 million, which he likewise depletes. Greater earnings fail to remedy profligate spending, do they not? Restoring dollar credibility demands but one remedy: abandoning the cycle of fiscal recklessness. One final puzzle merits resolution. If dollar credibility erodes and investors flock to gold, how do U.S. stocks continue shattering records? How can haven assets and speculative ones advance in tandem, defying conventional wisdom? In truth, both phenomena arise from a shared cause, dollar credibility's decline, and represent dual hedging mechanisms. The first approach acquires gold to safeguard against the dollar's intrinsic debasement. The second targets equities to surpass inflation's advance. As dollar purchasing power wanes and prices rise, cash holdings underperform assets. Hence, investors pursue both avenues, propelling parallel gains. To state it simply, America's dual monetary and fiscal accommodation, the proliferation of dollars, elevates asset valuations across the board. Wall Street's technology titans draw particular fervor for their robust cash flows, pricing authority, and AI-driven innovation, positioning them as the market's premier bulwarks against inflation. To conclude, this year's gold mania transcends mere speculation. It signals profound doubt in fiat currencies. We have awakened to our incapacity to rehabilitate monetary trust, as the requisite sacrifices prove prohibitive. Even the dollar, long the paragon of reliability, risks devolving into irrelevance. All observers foresee this trajectory. The variance lies only in timing. Such apprehension toward the horizon manifests as fervor for gold, rendering bearish positions untenable in my view. Gold's trajectory over the coming years may lack the 70s volatility, Yet its resurgence as a cornerstone asset appears irreversible. The U.S. persists in expending dollar credibility for superficial prosperity. Correspondingly, global central banks will inexorably augment gold reserves to mitigate the dollar's depreciation. In 1971, the dollar forsook gold. By 2025, the world reclaims it. A half-century on, the insight crystallizes. Paper currency's legitimacy arises neither from printing presses nor ballots, but from rigorous fiscal stewardship. Gold poses no imminent threat to supplant the dollar, but its ascent serves as an admonition. Prosperity financed through credit excess invariably incurs a reckoning. Should it go unpaid today, posterity will inherit the ledger tomorrow.
Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.